Thanks very much for coming along for the lunchtime seminar, and thanks for having me. So let me just give you a little bit of background to this topic. It's something that I first started thinking about when I was in the first years of my PhD and the first years of teaching. So that happened to coincide with the beginning of the global financial crisis. So I was doing insolvency law, and it was great for statistics because you could put the number of insolvencies up in your lectures and it was going higher all the time. And I suppose that was profoundly influential upon my thinking, and probably a whole generation of people like me who saw up close and partly suffered the consequences of the crisis. Because you could see that through the crisis it was very clear, it was very obvious to a lot of us that people were able to make considerable profit at the expense of others while performing jobs that maybe had no value at all or were positively destructive of value. So markets had failed massively, and so it was time, I think, for a look again at the economic theories that supported markets. And the interesting question was what corporations had to do with that. So if we look back at classical economic theory, we were told by Adam Smith, the father of economics, that markets were meant to deliver equality. So in the theory of moral sentiments, Adam Smith puts forward a view that because people of greater wealth have a more limited propensity to consume, their spending would tend to spread wealth amongst everyone else. So the invisible hand of the market, as Adam Smith originally conceived it, was meant to divide the world into equal portions. And so markets were meant to create equality. That was the invisible hand of the market. But we know that Adam Smith did not include corporations in this theoretical framework. So probably a reasonably well-known passage from The Wealth of Nations to you all if you're doing corporate governance is this one, that directors of companies, said Smith, because they manage other people's money, they're in charge of other people's money rather than their own, it can't be expected that they should watch over it with the same anxious vigilance that partners in a private co-partnery would. So Adam Smith was writing in a world where the South Sea bubble had still left a shadow of the way that the economy was regulated. Corporations generally couldn't be set up without an express act of Parliament. And so Smith was writing about a world of small partnerships of the butcher, the baker, the brewer. Corporations run by directors would be prone to negligence and profusion, so that's carelessness, reckless behaviour, and unjust enrichment, profusion at the expense of others. So corporations weren't part of how the theories of markets were meant to work, and ever since corporations have held a pretty uncomfortable place in the question of regulation. So that's where we get to the basic problem of rising inequality as we see it today. So as you all know, Thomas Piketty, Joseph Stiglitz, Pickett and Wilkinson have been writing a series of books, Capital in the 21st Century, The Price of Inequality, firstly documenting the fact that there is a very significant rise in extreme income inequality and wealth inequality over the end of the 20th century. But also looking at what we can do if we see this as a problem about it. So most of these authors take the view that it's mostly a question of absence of redistributive taxation. So the breakdown of redistributive taxation, particularly since the Thatcher and Reagan governments have played a big part. But they all allude as well in the background to corporate governance as an issue for inequality. So they identify it as a sort of pre-tax cause. Before you get to redistribution of income, there's a problem of corporate governance as a pre-tax cause of rising inequality. But that doesn't get fleshed out very much because that's just not their specialism. They're writing within from an economics perspective. So the starting point for my paper is, well, how exactly does the corporation affect rising inequality? That's what I'm interested in addressing. Two qualifications. So this paper is going along with, I think, a majority view that returns to labour and capital from a corporation, so that's wages that go to employees, dividends that go to shareholders, are not purely reflective of the marginal utility that a worker has contributed to production or that contribution of capital has made to production. So prices aren't purely reflective of the marginal utility. I think that the majority view is that prices also reflect the relative bargaining power of the parties. And so that's very well established in actual corporate regulation, if not in some strands of economic theory. But I think that's becoming the majority view. Second qualification is that inequality isn't merely a fairness issue or a moral issue, it's also an economic efficiency issue. And we have increasingly good evidence from behavioral economics for this, because we know that people who are overpaid tend to be less motivated to work. So that's Berlin means. It's an economic efficiency issue. If you've got high inequality, it affects production, because when you are very highly paid, you can profit from your office, you don't need to work. It's a production issue. Also, the low paid tend to be less productive. So it's not just a moral and a fairness issue, it's also an efficiency issue, and then there's also problems of collapsing aggregate demand and concentration of systemic risk. So what we need to do is create a grammar for understanding rules within a corporation. And here I distinguish in my paper between those rules which are significantly distributive rules and those which are not. So what would those be? The rules, I define them as the rules which allow people to influence the board's distribution function. So that is paying wages out to the workforce and also to themselves, paying dividends, making contracts, holding properly. So these are the rules which influence, these are rules which are about the distribution function. And the core example of a significantly distributive rule is the right to vote for who's on the board. As opposed to things like directors' duties, which I think are functionally capable only of making minimum standards, and rules which relate to exercise of rights on the market, selling your shares, and so on. So those tend to have a negative influence on distribution rather than a positive influence, which the right to vote does. And the basic theory is that if you get to participate in choosing the people who pay you, they will pay you more. It's a very simple idea. And also, conversely, if someone else determines who pays you for your contribution to production, there is a risk that they will unjustly enrich themselves at your expense. Now, another point is, before we get to the substance, is that this paper is purely confined in its analysis to private enterprise. So I don't think that you can have a one-size-fits-all of every kind of enterprise. The basic structure of private enterprise is that you have people making contributions to equity capital, so that's the beneficiaries of pension funds, life insurance companies, mutual funds. Their contributions to equity are organised by shareholding institutions, asset managers, and so there's a contribution going up of capital, and the board is exercising its distribution function down the chain. And on the labour side, you've got employees making investment of labour, and the labour is organised by a trade union. So that's the basic point. We're not talking about things like the banking industry, water companies, and so on, where the general laws of competition might fail the consumer or public interest. So what we can do is we can draw up a list of rules that have a significant distributive impact. And those will include, for example, the things that you see here. Rules on executive pay that determine whether shareholders' employees can vote over director pay. And we can use this. I mean, this is the sort of thing that we can use in lexometric research, like has been going on in Cambridge at the Centre for Business Research. And we can track, the basic methodology is to track the changes in these rules to changes in income inequality. We can correlate when these rules have changed over time and look at the impact that probably had on statistical data about inequality. So that's the essential method. So what I'm not going to do is spend a lot of time, because we're in a corporate governance seminar, on employee and union rights. You're more than welcome to ask me about that in questions. I'm happy to go into it. But I'm going to focus on executive pay and rights of beneficiaries against asset managers. I should also say that this is a comparative paper. I look at Britain, Germany, and the United States, mainly because they're probably the most important jurisdictions. They represent the Commonwealth, the United States itself, and a lot of what's happening in Europe. But I'm not going to talk about Germany. But again, you can ask me about that if you want. So executive pay. Two parts. First of all, we've got the story of what happened in the UK. And generally, it seems to be the story that there was a say on pay, a binding say on pay for the general meeting, and then it went back again. And in the US, maybe you could make an argument that it's pretty much the same. So the standard in the UK at the beginning of the Modern Companies legislation was very clear. Directors' remuneration shall be determined by the company in general meeting. So it didn't say directors pay themselves as it does today under the model articles. What it says in Article 64 is that there is a binding say on pay, at least under the model articles, and of course that was a default rule, so you could opt out of it. So if you look at the leading texts by Nathaniel Linley, Lord Linley, as I'm sure many of you know, Lord Linley says that directors have no power to vote themselves fees for salaries for their services beyond what the constitution of the company may provide. No power. And then in a footnote, he says that the directors may appoint one of themselves to be a manager at a salary, but the person so appointed ceases by the appointment to be a director. So that's telling you very clearly that although, of course, there's a split between who's on the board and who's in management, the people at the top, and that's the ones that we're really concerned about, would have the general expectation was that their pay would be set by the general meeting. Okay, so that's the historical starting point, but then, of course, we know that it changed over the 20th century. Now, the data is not very good. So this graph that I'm putting up now is not going to seem too fulfilling, but maybe we can say a little bit about it anyway. What this shows is Piketty's data on income inequality changes. So if you look at the right side, the blue line is the percentage of income received by the top 1% of income earners. So anyone who's following Piketty will know that the general idea is that there's been a U-shape in most countries. Inequality decreased over the early 20th century. And went up again over the later 20th century. And what you see in the purple line at the end is the limited data that we've got, historical data, on CEO pay, Chief Executive Officer pay, as a multiple of the average employee. So it doesn't go back very far, but what we can see is at the beginning of the 21st century, end of the 20th, is that there's, as we know, a very significant rise from around 40 times CEO pay to average employee, to well over 100, 120, even after the global financial crisis. Now, how does this map onto rule change? Well, basically, through the 20th century, there wasn't much alteration in the law to the basic rule that the general meeting set pay. So in the 1929 Act, there was a provision brought in saying that pay should be more transparent if shareholders asked for it. In Section 29 of the 1947 Act, the general meeting got the right to dismiss the board by ordinary majority, so that's significant. This is just all sort of background to what's happening generally. And then what we know is that there was a big change around 1985. So the default rule was switched in 1985 under the new Table A. It essentially moved from saying that the general meeting shall determine the pay of the board to the general meeting may determine the pay of the board. So that doesn't mean that companies couldn't switch their own rules in the constitution before that, but because now it wasn't compulsory in the standard model articles that the general meeting shall determine the pay of the board, it meant that the board could essentially ignore what the general meeting's wishes would be. And then we've got the story about the Cadbury report recommending independent directors as some control. We've got the say on pay regulations in 2002. And of course, this has absolutely no consequence, or maybe even bad. There's some theories, of course, that more transparency is going to lead to greater pay. So we don't have very much data on pay. We can go back a little bit. So this is not exactly comparable, which is why I haven't tried to map it onto that graph, from an article in the Financial Times. So this shows the total pay of FTSE 100 boards. And we can see a rise from the beginning of the 1980s and a divergence between total board pay and average earnings of employees in FTSE 100 companies. So we can see at the beginning of the 80s those paths splitting. So that isn't as extreme as the first graph's rise because that's total board pay as opposed to CEO pay. You'd expect that CEO pay would be going up even faster at a greater rate. Okay, so we need more data, but there is a consistent picture between CEO pay and overall inequality. So that's the first essential point. Companies could switch the default rule before we start seeing big rises in pay, and the law was decisively switched in 1985. Now let's turn to the US, where we see a little bit more data and it's a bit more helpful. So the rule in the 19th century generally, and of course we can't we don't have one picture for every state because there's many different states in the US, but the general standard, and I think most academic commentators would say that compensation was meant to be fixed by either a corporation's charter or the bylaws approved by a majority of the corporation's members. So we've got Moravec in 1886 saying, very straightforwardly, much the same as Lindley in Britain, it would be contrary to established principles to allow the directors or other agents of a corporation to fix their own compensation. Why? Because there's a straightforward conflict of interest. Now if we turn to the statistics, this is much more enlightening. Again, we've got Piketty's data showing a U-shape in the top 1% of income received, in the income received by the top 1%. So we've got the U-shape over the 20th century, just like in the UK. We've also got much better historical data from the US, to my knowledge, about executive pay. So on the right-hand side, in the unbroken purple line, we see a big increase of the CEO pay as a multiple of the average employees. So that's from Davis and Michel. And then an old book by Llewellyn shows, not for all companies, but for manufacturing companies, and that's a decent proxy. We see a pattern of pay being reduced after the 1940s for executives in relation to manufacturing employees. So essentially, executive pay is mapping on to the U-shape that we see when we have good historical data. And I don't think that is a coincidence. Now, I'm going to cut through some of the extra details on there, but I want you to focus just on this essential rule in the Delaware General Corporation Law in 1969. Previously, back in Carhell and Luftland, the Delaware courts had said that there had to be an explicit provision in a company's constitution in order for directors to set their own pay. Otherwise, you couldn't do it. Right? There had to be an explicit provision, so you had to opt into it. But what the 1969 Act did is it said, quote, the board of directors shall have authority to fix the compensation of directors. Right? And that is at the start of that big upswing. So we don't have a salary stabilization unit anymore, which was the government controlling top wages, but that is really the start of the big upswing in executive pay across the US. The basic summary over all of this is that in the UK and the US, the General Meeting usually had, but then lost, a binding say on pay. So the times when that loss occurred in the default rules of a company constitution don't immediately trigger pay rises, but what they do is enable directors to take advantage of their conflicted interests. Now, the time doesn't match accurately because we're not dealing with legal change automatically leading to social change. There is a time lag because it takes a while for people to act on the powers that they have. But we can ask why that is. And also, even if shareholders lose a say on pay in the UK, and often in the US, shareholders can dismiss the board if it doesn't control pay. So we also need to ask, why is it that shareholders in the UK, even though they lost a say on pay, mostly after the 1980s, why is it that they didn't just exercise their rights under Section 168 now and dismiss the board if they didn't like it? And so the answer has to connect to who shareholders really are. And that's what we're going to move on to now. As I said, I'm not going to go into labour, but I do want to just show you two charts about the relationship that labour income has to inequality and more particularly trade unions. So what you see here is a mirror image, essentially, of the changes in inequality that Piketty records and trade union membership. As you probably know, there's a single channel model of industrial relations in the UK historically. Unless you have collective bargaining through a trade union, you don't have much voice at work. And so we see an essential mirror image between inequality going down while trade union membership has gone up. And I don't think that that is a coincidence. I don't think that over the 20th century there could be such an obvious spike in union membership and a decrease in inequality. And then you even get it just before the end of the Second World War. I think it's obviously related. Now, I don't want to go into that now and the reasons for union membership changing. What I want you to see is that as unions were becoming stronger and they had more numbers, obviously they were making collective agreements for better pay and conditions. One of the main things that a union would want to bargain for would be an occupational pension. So what that means is that there's going to be an awful lot of new money from people at work going into occupational pension plans or retirement savings as a whole. And that is going to create what Brian Sheffens has called a wall of money, flooding into the financial system. Essentially the same thing is happening in the United States. As people become more affluent, as collective agreements are better, as people are more organised in the workplace, that means that there can be more pension money and retirement savings money in the financial system. A wall of money which is going to be capable of being used by asset managers if they start appropriating shareholder voting rights. So that's what we get to now, asset managers and beneficiaries and the relationship between the two. 3 essential points. There is a historic shift in the late 20th century from individual to institutional share ownership. Most of the institutional share ownership is now retirement saving money. Pensions, life insurance policies from people who are perhaps slightly more affluent, mutual funds. And of course, the reason that you want to put money into a managed fund is again largely because you want to save it for a rainy day or for retirement. Asset manager intermediaries started appropriating the voting rights, the shareholder voting rights that individuals used to have. And this creates a doubling of what is classically the managerial agency problem. So the old managerial agency problem that Adam Smith identified is that if directors are not accountable to shareholders properly, if there's a separation of ownership and control, then directors aren't going to act in a way that maximizes or reflects the interests of the people that have contributed to a company. Now you've got a double agency problem because you've got beneficiaries giving money to shareholding institutions and ultimately asset managers, and then those shareholding institutions contributing capital to the company. So a doubling of the agency problem, another separation of contributors to equity from participation in governance. Asset managers took over most shareholder voting rights as, first of all, executive pay rose, and second of all, which is I think probably even more interesting in the wider picture, is that the finance sector was consuming much more in GDP. So just to make it crystal clear, this is the typical investment chain. Usually you have an employee saving for retirement through the life insurance policy or pension fund. That money will go to a pension fund, life insurance company, mutual fund. That money is then passed on usually to an asset manager or another country's banks or perhaps broker. And then it goes to custodian's nominee and ends up with the company. So generally speaking, shareholders at this end of the chain, the asset manager or the custodian nominee, they're going to be the shareholders together. They can hold, through company regulation, directors to account. In many situations, the people at the end of the chain, employees, individuals, can hold their pensions funds to account. But there is a break in the chain of accountability. Often it's very difficult for pension funds to hold asset managers accountable. So asset managers are usually the shareholders, and there's not usually much in asset management contracts about how voting rights work. So there is a big problem that is unregulated in the investment chain. And this leads to mass potential conflicts of interest. So the basic theory is that if an asset manager sells a retirement product and controls shareholder voting rights, what's it going to have an incentive to do with those shareholder voting rights? It's going to have an incentive to push directors behind the scenes, perhaps, center stage, if you like, in order to buy the financial products it sells. It's a mass conflict of interest. It's going to pressure for companies to convert from big collectively organized pension schemes to individual pension accounts. It's probably going to be more likely that you see companies shifting from DB to DC schemes. If the asset manager that controls the shareholder voting rights is selling the products that would be organized in that way. Right? So that's a mass conflict of interest. Asset managers will attempt to sell also to the big pension schemes that they are operating. They're going to attempt to sell more and more complex products. There's going to be a growth in derivative products. There's going to be a growth in funds of funds. And this is just the logical incentives that you would have if you were an asset manager selling a product, but you're also controlling shareholder voting rights. That's going to be more hedging. That's going to be more churning. And as far as executive pay goes, there's also a potential conflict of interest and potentially massive conflict of interest from the asset manager who is very highly paid. They're not going to be likely to challenge very high executive pay. So I think these are all very real problems, and I'm very pleased to see that a couple of weeks ago, the Department of Business has just done a research report recognising all these conflicts of interest explicitly. So the thing that we get from looking at changes in shareholder ownership in the UK is we can see a picture where there would be, at a certain point, a tipping point where we could identify, through contract, the potential for asset managers to take over shareholder voting rights. So don't worry too much about the labels, but what we can see in the UK is, as we know, there's been a decline in individual ownership of shares. That's the blue line going from the top left to the bottom. Terminal decline in individual ownership. So there's not that many people buying shares through a broker at NatWest or Barclays these days. And we get the rise of collective bargaining, producing better pensions, and then you get more collectivized investment. And there's going to be a tipping point, I would suggest. It's at a point there when individual ownership becomes low enough and institutional ownership becomes high enough for asset managers to start exercising a dominant influence in corporate preferences. In the United States, we see, again, something very similar. Terminal decline in individual ownership, although in the States it's a bigger market, so there are differences, of course, and a rise in institutional ownership. Not quite to the degree that we see in the United Kingdom. Perhaps for those of you who are interested in the pension and move from collective schemes to individual schemes, you see that crystal clear in the United States. Here in the green line you see ordinary pension schemes, and in the orange line you see the rise of 401k individual pensions. So those are counted under the mutual fund heading in the United States. So those are very, very good for asset managers in the States because they're individual accounts, you can get more fees, right? And it's going to be much more easy for you as an asset manager to extract more wealth out of people's pension plans. On the other hand, you have a decline of collectivized pension plans that would be collectively bargained. Now, how does this map onto inequality? I think that one of the most telling charts is here. I'm still looking for data from the United Kingdom, but US financial institutions' share of the gross domestic product begins after a certain point when you get significant amounts of retirement saving money going into the markets through the late 60s and early 70s. All of a sudden, inequality starts to correlate very strongly with changes in the financial institution's share of the gross domestic product. And that's because there's so much money now in the financial markets because there's been so much put in through retirement savings. And then we start to see very real mapping or correlation of inequality and the growth of the financial sector. So I'd just like to wrap it up there with some final conclusions. Asset managers, number one, have an incentive to keep board pay up if they are also very well paid. Their interests diverge from the clients whose money they are representing when they have appropriated shareholder voting rights. They are able to profit from their office rather than by working hard, so that's the double managerial agency problem taken from the board of directors originally, now down to another level at asset management. The financial sector, second, is able to inflate its income through using shareholder voting rights to make corporations buy their products. And this increases inequality by concentrating income in one sector, finance, at the expense of a productive economy. So thanks very much for listening, and I'd be more than happy to hear all your questions and criticisms.